Hello and welcome to the Week Ahead with London Capital Group. Now joining me for this week's Week Ahead is LCG Head Analyst Brenda Kelly. But first of all, it wouldn't be right to discuss the week ahead without discussing this week's price movement in the financial markets. That's following yesterday's ECB press conference and of course today's US non-farm payrolls report. Brenda, thanks for joining me. Now a very busy end to the week. We saw the European stocks drop on Thursday while the euro also hit a 1-month high against the US dollar. That was following the ECB rate decision. Now, do you think Draghi failed to fully deliver in your opinion? I mean, the market certainly seems to think so, especially looking at CTAM's Grinch picture this morning. And what about key technical levels now to watch in Eurodollar?
Well, I think ultimately what you have to remember that Mario Draghi did actually promise an awful lot, but I think the markets took it as a lot more dovish than what he intended. You also have to remember that he's just one vote on the Governing Council, and you will have a little bit of pushback from some of the Germans. And certainly in light of some of the data coming out of Germany recently, you will be vindicated in thinking that perhaps what he did was enough, and it leaves the door open for additional stimulus if necessary, particularly in light of inflation levels and of course any geopolitical risks that might arise over the next couple of months. Equally so, you also have the Federal Reserve about to make their rate decision later on this month. So perhaps Janet Yellen can do some of the heavy lifting for him in respect of the euro-dollar pair if they hike by 25 basis points, which is widely expected. So for the time being, we have seen quite a dramatic move in the euro. I mean, nobody would have expected to see the euro, the best performing currency in the G10 yesterday, following what was expected to be a very dovish ECB presser. But it did actually happen. It is still an accommodative policy that the ECB has put forth. It doesn't have the additional quantitative easing that many were expecting. And of course, the deposit rate was cut by 10 basis points, not the 20 to 40 that some were lining up. So I think it was a very one-sided trade. Many were expecting parity in the euro dollar. And as a result, I think the markets got a little bit too much ahead of themselves and got quite a surprise when Mario didn't deliver what they wanted. But I think Mario delivered quite adequately.
Okay. I mean, we got another upbeat. We'll talk a bit more about Eurodollar key technical levels to watch as well. Another upbeat NFP reading today. 211,000 new jobs were added to the US economy in November. We also got upward revisions being made to September and October's readings as well. You mentioned the Fed and Janet Yellen a moment ago. What does this mean for December's Fed meeting and what's going to be the next drivers in terms of dollar movement and, as I mentioned earlier, the euro-dollar technical levels?
Well, I think obviously today was a very good number. Beat the street estimate by 11,000. Wage growth was 0.2% on the month on average, a little bit lower than the last time round, but certainly the trend is there and it is going supposedly in the right direction. I don't think the headline number was going to have such an impact on the Fed. I think Janet Yellen had very much versed the markets that even something close to 100,000 wouldn't necessarily preclude any hike from the Federal Reserve. So I think whatever happens over the next 10 to 12 days is going to be critically important. And I think it'll be external headwinds or factors that will be the deciding factor for Janet Yellen rather than any domestic data coming out of the US. That being said, we do have a number of bits and pieces coming out before the Federal Reserve, including the retail sales. And I think that is obviously a major component of the US economy. We saw auto sales staying at a very high level in November and gasoline prices continuing to decline. And of course, even today, we're seeing West Texas Intermediate falling below $40 per barrel. So all of that should add up to fairly decent retail sales. For the time being, though, it is expected that we're going to see a 0.3% rise in the month. Not a huge, great big deal, but some of the other brokers are expecting to see a little bit higher than that, maybe a 0.5%. Again, that will be pretty much bullish for the US dollar. We've seen 2-year yields on the 10-year US treasuries actually rise to levels we haven't seen in a number of years. So I think the markets are very much penciling in a 25 basis point rise by Janet Yellen. And unless we get a pretty dire retail sales number, which is quite unlikely in the run up to the holiday season, then it will take something quite unusual for Yellen to bottle it.
Well, you mentioned US retail sales coming out next week. Looking at next week as well in a little bit more detail, anything else on your radar in terms of data releases and events scheduled?
Well, sticking with the US, the consumer confidence number was pretty, well, dodgy really the last time we saw it. It declined somewhat since the first half of the year. And of course, with the fact that we've seen the S&P 500 clamber back down from the 2100 resistance level, falling quite dramatically yesterday in the aftermath of the ECB meeting and the result of that, I think that will go the same way for consumer confidence. They do tend to work in lockstep with each other. So we could see maybe that index drop to around 89.9, down from the 91.3 we saw in November. But again, I'm not so certain that that will be a major factor for Janet Yellen, but it's certainly something for markets to watch. And I think over the next week or so, despite the fact that it seems to be a 78% chance of a hike priced in, markets will still be looking for any sort of areas of dissent that might change Janet Yellen's mind. So a certain amount of volatility can only be expected there. When it comes to euro dollar though, we saw that dramatic rise from the 105 level, and I think above the 104.80 level, which is the basic support, and it really kind of comes in on a monthly chart since the inception of the euro as the trend line support. So while above that particular point, and given the fact that the market seems to have priced in a Fed hike, then you could actually see the euro drive that bit higher against the US dollar. So I wouldn't rule out a move towards the, say, 110.80, but we will need to break the 109.80 in order for that to happen. So for the time being, a certain amount of consolidation with the 107.50 level at the sort of base, and that will provide us with the direction. So that's the near-term support, 109.80 at the top end, and of course any drivers through the top or the bottom end will give us our resultant factor. But I don't see euro dollar going to parity by the end of the year.
Okay. You just given a nice detailed look on the euro dollar. Are there any other interesting FX pairs, or in terms of key technical levels in commodities? What are you looking at next week as well, except from the euro dollar?
Well, certainly euro dollar is one factor, but clearly the euro side of it is going to be important as well. We've got German industrial production, and we also have the Eurozone GDP due out too. So it rose 0.3% in the quarter in the third quarter, a little bit below expectations certainly, but nevertheless, you know, it does seem that Mario Draghi's initial QE program has helped. Credit conditions and interest rates on the high street have fallen, and credit growth is in fact actually expanding. So you see Germany, which actually grew 1.3% in the quarter. A lot of the data from there over the last very recent past has been exceptionally good, and would, I suppose, bring back Germany to its sort of mantle of the core within the Eurozone economy, the engine of the economy, so to speak. So there is a possibility that net exports there could actually be a drag on growth for Germany. So that could bring us in again about the 0.3% growth level in the final quarter of the year. Aside from that, I do feel that China will still be very much on people's radar, and I think if you're trading the FTSE 100, it is very important that you're aware of anything that's coming out of China. So we'll have the CPI data. Again, that's expected to see a little bit of a move higher on the back of a 1.3% year-on-year fall in October. So we're expecting to see that on a yearly basis at 1.4% growth year on year. Not a great number, and certainly with many expecting to see a certain amount of stimulus in the markets from Beijing, it might very well be the reason for the markets to fly that bit higher. But with commodity prices still very much under pressure, iron ore, copper, there's going to be a problem for the FTSE contingents to actually break out of the particular range they're in. And the fact that we have failed at the 6,445 level on several occasions is a 50% fib retracement from the recent all-time highs, or recent highs this year, should I say, to the lows that we saw back in August. Below that level, there is still a propensity for us to move back towards the 6,060 level. And as at present, we are consolidating. We have remained above the 6,250 for the time being, and there's decent support at 6,200. But we are looking at a bearish flag formation on the daily chart, and if we fall below that 6,060 level, then I would anticipate that the August lows could very much be a target there.
Okay, all right, Brenda, thank you ever so much. That was Brenda Kelly there, giving us some great key technical levels and also what to look out for in the week ahead. Now that's all we've got time for today, but join us next week. Have a great weekend. Goodbye for now.